Hello and welcome back to the ROI channel, the channel that's obsessed with all things to do with the art and science of return on investment. Today we're talking about an interesting stock within a very interesting sector, very timely. Stock is the L3Harris Technologies, which is a defense stock. Aerospace and defense is a very, very interesting sector, and we're going to get into it today and say why it's in the Crassus investment funds and why I believe this company is very interesting moving into the future. Before we get into it, as always, if you haven't liked and subscribed on YouTube, we'd greatly appreciate you doing that. If you're on eToro already and not following the portfolio, feel free to add me to your watch list. And if you've got some funds that you want to invest by copying the portfolio, then you're always welcome to do so. To give you a better idea as to the process that I go through before deciding whether or not to put a given asset into the portfolio, if it's publicly listed business, this is the formula that I use. We want a company that's low debt, usually defined as net debt to EBITDA of less than a 3 times ratio, margin of safety in price, in the balance sheet, and in the discount rate which we use to discount its expected future cash flows. We want to see top line sales growth, strong margins, free cash flow growth, and ideally share buybacks. If we can get those, chances are we're on to a good thing. Quick facts about L3Harris Technologies. Revenues expected to come in 18.1 billion with an EBITDA of 3.9 billion at the end of 2021. So 13% and 12% compounded annual growth rates respectively. Market cap 46.6 billion, enterprise value 52.5 billion. Shares on issue currently 200 million or so. $3.1 billion worth of share repurchases last year. Now that accounted to, if you use an average share price of about $200, that's about 7% of the entire shares on issues that were torn up. That may or may not happen every year. Last year was COVID, obviously, in 2020, so companies' stock values dropped. Those with a little bit of cash it saw the opportunity to go onto the open markets, repurchase their shares, and tear them up, which is great for we the shareholders because it means that we get greater claims on future cash flows and earnings. Return on capital, it's about 9%. It's okay, not the best, but it's it's not a growing industry necessarily. It is, but it isn't, and I'll explain what I mean by that in a moment. Price $232.20 US as of the time of filming. Our net debt to EBITDA ratio is 1.5, so all is clear there. A little bit of a messy slide, however, let me go through these points. So it is and it isn't a growth industry. It's been stable over the last year, so it hasn't grown, but it hasn't shrunk either, like a lot of other industries. When it comes to aerospace and defense, those industries emerge. Crassus is not invested in aerospace as such in terms of commercial aerospace. So we don't own any airliners or anything like that. There are some interesting plays out there, but we don't currently own them. We do, however, own and like the military aerospace and defense sector. So let me explain what I mean by that. So commercial aerospace, as it says there, could remain challenged, and this has been taken from Deloitte's annual industry outlook. I've left the link down the bottom there. The defense sector, of course, is expected to stay stable or even growing. Given what's happening around the world at the moment, one would expect defense spending to continue to increase, and because the geopolitical tensions are rising through the roof. There's sovereign debts which always preclude geopolitical tensions, or not always, but generally speaking, preclude either cold wars or hot wars. Hopefully not, but in this case it looks like things are escalating quite rapidly, and as such every nation around the world will want to defend themselves, and so defense spending is an inescapable part of that, and we want to be involved in those tide which raises all boats in terms of industries growing, and we want to pick the best companies in those industries to be a part of those tailwinds. So going through here, global defense spending expected to grow about 2.8% in 2021, crossing the $2 trillion mark. So it's a $2 trillion industry, and it's a necessity. So it's stable, and it's a growth industry at the same time, which sounds like it's a contradiction in terms, but you'll see here, and if you go through and read the article, you'll see what I mean. Despite the pandemic, countries still have to spend on their military to be able to defend themselves. Growth in the foreign military service in the US is likely to continue into 2021, boosting an export opportunity for US defense contractors. Now, there are three big ones that I really four big ones that I like in the space. L3Harris Technologies is one of those. I'm going to talk about some of the others later down the track, but I'm still in the process of buying them, so I'm not going to divulge them just yet. Interestingly, other places around the world, not just the US, China announced $178.2 billion military budget last year, so that was up 6.6% year on year. India is bolstering its military. There's a lot of stuff going on in the Himalayas that we need to keep an eye on. And Japan is increasing its air-to-sea military capabilities, announced a $51.6 billion defense budget for fiscal 2021, which means they've increased their defense budget for 9 straight years on years. Now, given what's happened in Afghanistan, the US leadership is incredibly weak at the moment, and so all US allies are now starting to wonder if they can count on the US for their safety. Okay, so moving into Southeast Asia, you've got the Straits and Taiwan, and then a group of islands around there that is actually belongs to Japan. Okay, so Japan's looking at this saying, well, China are encroaching into the Himalayas in India. The US is very, very weak. They're supposed to defend Japan, but what happens if they pull in Afghanistan and leave the Japanese all on their own? China has made no secret that they want to, or that they expect the world to recognize Taiwan as Chinese territory. They have thinly veiled plans to invade Taiwan, and it's only really US and Japanese military that's stopping them from doing so at the moment. So if the Chinese were to enter Taiwanese territory and those adjacent Japanese islands being quite close, I suppose from the Japanese point of view, they're saying, well, there's nothing to stop the Chinese advancing it and looking to encroach on their territory in those adjacent islands, especially with the US supposedly being the one that's supposed to police the area. But given everything that's happened and just the insanity in the White House at the moment, countries around the world who are counting on the US for their safety, namely Japan, Taiwan, Israel, would be the main ones, as Saudi Arabia also, then we could see some things really starting to shape up. Point being, that's all going to lead to military defense and growth in that sector. Okay, so L3Harris, let's look out short-term projections for the end of 2022. Here are the estimations. So analysts are estimating the free cash flows, the EBITDAs, and the EPS, which I put in those columns, and use the industry median multiples for each. If we go through, we get an average price expected at $303. So from where the share price is now, it's about a 30% upside, which is not bad in a little over a year. Here, as I move, never know where to put this thing, move the camera out of the way. Let's look forward 10 years and say, okay, if we buy the shares today, if you follow the cursor there, that's the initial investment that we'll make. If we go through and use projected growth rates, so I've used the free cash flows here and historic growth rates for those free cash flows, and we take an exit in year 10 at the industry multiple, so what the market is willing to pay as a median multiple of those cash flows. And we look at the company's cost of capital, we discount those cash flows to the company's cost of capital, we end up with an IRR of 21.35 is what we are expecting, which is very, very good. It's comfortably going to beat the market, historically speaking, and it's above our target return of 20%. If we go a step further and we run through various scenarios with various probability weightings with various inputs, those are, of course, free cash flow, earnings per share, and EBITDA, and I get an average of those three metrics using historic growth rates for the base case, using slightly more bullish cases for the bull case, and then bearish cases, obviously, for the bear case, in not only growth rates but also the multiples, and we keep the discount rate, if you're following my cursor there, at 20%. Why 20%? Because that's our required return. So instead of taking the projected cash flows and discounting them at the cost of capital and finding out what that would be as an annualized rate of return, as we did in the last slide, we're essentially reversing the process and saying, okay, these are what we expect the cash flows, the earnings, and the EBITDA to be. If we discount it using our required rate, what is the intrinsic value of the company? So down here, what you'll find is the average of those three metrics using that philosophy says that in order to get a 20% expected return year on year, or IRR over a 10-year period, we would need to buy the shares at or below $284.40. Okay, so at about 230 today, we're comfortably in there with a margin of safety. So that suggests that the shares are good value. So I bought already a little bit of L3Harris, makes up about 2.88% assets under management. I think we've increased. Our positions increased by about 7% just because of the appreciation of the shares from whence we bought them. I'm not currently buying any more because I'm looking at comparing L3Harris to the four other so defense or aerospace and defense orientated stocks that I'm interested in. So I'll talk about more about those. When I initially went to enter the position, L3Harris was the best value. There's now another company that looks slightly cheaper on a market cap to free cash flow basis, and I think there's room in the portfolio for both of them, meaning they do different things essentially. So L3Harris is mainly concerned with ISR technologies, which, if you don't know, is reconnaissance tools. If using drones and those sorts of things, if you've got an assault team on the ground, like a SEAL team, for example, what the drone and ISR technology does is essentially provide a visual, a heat map, reconnaissance of the area, and so in real time the communications can be going to the team monitoring the drone to the assault team on the ground, so they can inform them of hostiles entering the area. It can inform them of distances and expected timing to meet allies, friends or foes, or whatever the case may be. They're the eyes in the sky, and L3Harris is responsible for manufacturing and selling a lot of those technologies, as well as the maintenance contract that go along with it. So in summary, does it meet our criteria? Yes, it does. It's got low enough debt. Margin of safety is there. Its sales have been growing and they've been maintaining their margins, free cash flow growth, and they have a good history of share buybacks. So that's the reason why we bought them in the first place. We're holding them, we're not selling them, but I'm not buying any more currently because I think there may be room for at least one other defense related stock in the portfolio. So I'm going to leave it there. If you haven't taken the time already, click on the link in the description to go to the portfolio on eToro. Check it out. If you've got some funds available that you'd like to copy the portfolio with, it would be my honor to be able to help you grow those. And if you haven't liked and subscribed to the YouTube channel, please do so. It helps me get these stock reviews out there, and it helps me keep an ear on the ground as to what people want to see. So if you've got a given business you want analyzed, by all means let me know in the comments. And as always, only sensible to do your own due diligence, guys, so please read the disclaimer. And other than that, I hope to see you again soon. Wishing you all the best in your investing.